A very good morning, good afternoon, and good evening to all. Myself Vaibhav, and in today's session of automated trading, we are continuing our work with the algorithm involving the linear regression intercept and the SMA. This is the second part, and we are back after 2 days of summer holidays. So I hope you are feeling fresh and raring to go to get started with our algorithm development. This is a technical description here, the SMA and the min-max and the ATR as well. Before we get started for the day, this is a standard disclaimer. Here I would like to remind that this session is simply for the tutorial purpose and no claim is being made regarding the profitability or otherwise of the algorithms which we will be developing during the session. Suppose if you want to use any of it, I would recommend that you do extensive testing and also run it on the demo account for a live kind of you can say demonstration of how it is going to work in a real environment. And of course nothing in the webinar is to be constructed as an advice to trade or for any particular setup. With that we get back to the charting. Our setup is fairly simple and we have done the work on Monday. So here in today's session we will try to see if we can get to work with the buy side. We have brought in the indicators blocks and we have done the instrument subscription. This time around we are working with the USD JPY and the position amount has been defined at 0. The linear regression intercept defined on hourly. Here we will have to make the change. It should be hourly. All of these LRI values are defined in hourly parameters, and also the SMA. The min-max is going to be defined for 3 hours 10 minutes and the time period is 18. So 10 multiplied by 18 you get 180 minutes, which is 3 hours. And here is the bid low price, so we will need to add the ask and the high price as well. So I will explain to you the idea briefly. We are going in for a buy trade as and when the last hour's candle close. So I will take the example where I see the conditions are in place for a buy trade. Let us assume I think we also have that condition of the candle close 10 hours back should have been below the linear regression intercept. So here the time is 9 GMT, and that means yes, we have this condition in place here. So I would explain to you as and when the last hour candle close is above linear regression intercept as well as above the 100 SMA, the buy trade will happen provided the volatility, that is the difference between minima and the maxima for last 3 hours, is above the 40% of the daily ATR range, and we are bringing in that condition to make sure that we are getting involved on the trade only when there is a good enough price momentum, and for the direction purpose we are relying on this, and to make sure that there has been a good enough consolidation and correction, and now this is the time when the momentum is picking up. We have brought in this condition that this hourly close 10 hours back should have been below the linear regression intercept, and also to make sure that trade is going to happen only during the initial phase of the trend start. So we are bringing in this condition as well that last 3 hours minimum value should have been below the 100 SMA. So that is for the buy side, and for the sell side we will want the last hour close to have been below the linear regression intercept, and as I said, the volatility at least 40% of the daily ATR, and the hourly close 10 hours back should have been above the linear regression intercept, and also the last 3 hours maxima above the 100 sorry, yes, the 100 SMA. So that will be our prerequisite for the buy side and the sell side trades respectively. So we now go back to the Visual J4X platform, where we are bringing in the conditions to make sure that we are able to give shape to our logic, to our idea. So here, this is good enough. Linear regression hourly, and the shift is 1, last hourly close, then the SMA, and we will also need to bring in the one more min-max block. Okay, and then the historical candles as well. So we now have to get here we have got the min-max, and this is going to be for 18 candles of 10 minutes each, and to make sure that we are getting the maximum value, we make it the ask and the high price. So we have defined this condition as well. Now we got this min-max conditions in place. Now we have to bring in the historical candle data of 1 hour each. So here we will need info, get historical candles, last hourly close, and then the hourly close 10 hours back. For that, one more will be needed. Okay, so here we have to change this time period to 1 hour. It is hourly now. Shift is going to be 1. Again, here also change needs to be done. 10 minutes. Bit side, that's okay, and we make it 10, and here it is going to be the output value is candle 23. So far so good. We have got linear regression intercept, the SMA levels, and the min-max blocks, and historical candle values as well. Oh, here I forgot to change. It should be 1 hour each, so it is going to be hourly. Okay, yes. Now I think we should also get the calculation done for defining the 40% of the ATR. So let me see if I have brought in the ATR. No, ATR needs to be brought in on the daily time frame. We will also need to do the calculation, the difference between min-max values, so that we can compare it to the ATR range and make sure that there is enough of volatility. So that needs to be calculated. So first thing we do is get the ATR block, and I think it is in other. Yes, ATR is here. So we have got this. And we place it here. Okay, Default instrument is alright. This needs to be changed to 1 day daily, and the shift is going to be 1 yesterday's ATR value, and that is to make sure that we are taking the volatility till yesterday. And now that this is in place, we need to get the calculation expression blocks to carry out the needed calculations. Mathematical, here we got the calculation expression, and we will define the 40% of ATR. So we get this, we create a fresh variable, create a new variable, double type, and we write it as a d small and 0.40. Okay, so here we got this, and it will be a1 into a2 and this will be minimum ATR difference, MAD. Mad. Okay, so we have got the condition in place for defining the minimum volatility. Now, to calculate the actual volatility, we will need to carry out the calculation, the subtraction of minimum value from the maximum value. And for that, we have to take into account one more calculation expression where we take the maxima of the high price ask side. So here is the maximum value and this is the minimum. Both are current values, and we do a1 minus a2, and the result of calculation is going to be the actual ATR difference, AAD. Okay, so that is also in place. So here we have this to measure the volatility in the price momentum. Now we will compare, not now, we will be comparing before the order execution these both of these values, and the volatility should be higher than the minimum requirement. So that is the purpose for this calculation. And we have to define whether to go for a market open or whether to go for a pending open, and in such scenario I think going in for a pending open is more desirable, given the fact that we are bringing in the entry point just when the volatility has picked up and the crossover has happened. I think if we give some time for things to settle down, bit maybe sideways momentum or some corrective momentum later on, then that is likely to grow more profitable, or you can say appropriate, as well as we won't really be jumping the gun, rather we will be waiting for the opportune time to come. And in such scenario, I feel it's a kind of you can say optimum as well to go in for a pending open. And now is the question to define what should be the difference between the current prevailing price and the order. And of course I am here talking about the limit order. So if we are going for a buy order, then it will be placed below the current price, and if we are going in for a sell order, then it will be placed above the current price. So in case of a buy order, I think the difference between last tick price and the level at which the order is going to be placed can be defined with the help of the daily ATR range. Maybe just I feel we can try about getting a entry point lower by around 20% of the daily ATR range, and that should be good enough. And similar kind of stop loss can be placed. So I think that should hold well. So we will again carry out one more calculation where we define the 20% of the ATR range. So here is that calculation. Line 24 is our daily ATR, and we create a fresh variable here, create a new variable at the entry difference pips, and it will be 0.20. Okay, so now we take this EDP and we multiply it A1 into A2. Okay, so here we have this, and the result of the calculation is going to be entry difference, which we will add or subtract depending on the side of the trade. So we save this value and we join the dots. So here we have done this. Now now we have to start defining the entry point and the exit points, and also the order validity time. So for us, the entry point is going to be from, so we do the calculation here for the limit order entry, and as I said, we are going to need three calculation blocks, one for the defining of buy side, one for the defining of the sell side, and one for order validity. So here we have to get this calculation done, and then we can start building onto it and add the requirements, the conditions for the buy side trade first and then the sell side trade. So here we have defined the entry difference, and that is going to be the 20% of the daily ATR of yesterday. So now we have to, for the defining of buy point, the buy entry point, we will need to subtract this ATR range from last tick price, and for the sell side we will be adding this entry range to the last tick price. So let us first do the buy side defining of entry point. So we have to now take the tick price, last tick ask, or the bid. Since we are going in for a buy side, I think bid should be good enough. So we take last tick bid, and then we take this difference, and here we have to do the subtraction, a1 minus a2, and this will be our buy entry point, BEP. Okay, now for the sell side we have to take last tick ask and then add the entry difference, and here we get the SCP, sell entry point. Okay, oh, here we have to a1 plus a2, and then we have to also define the validity, and I think 3 hours should be good enough. Suppose if you want to change it, suppose if you want to keep a different configuration, or like you want to keep order validity only for 2 hours or 1 hour, or for that matter 4 hours, you can do that. It's a fairly simple setup, so nothing much to worry about on that count. Here for demonstration purpose I am going to keep it for 3 hours. So what we have to do is take the last tick time and then add 3 times of 3.6 million ticks. 1 hour consists of 3.6 million ticks, and since we are going in for order validity of 3 hours, we need to multiply those 3.6 million ticks by 3. So we have to create fresh variables here. We will need 2 variables now, and one is going to be tt, tick time, ticks, and here this will be 3.6 million. I hope I have got the number right. Yes, it is most probably. If I have mistakenly made a mistake, you should keep it in mind to correct it. Now we have to define one more variable, and this will be the OV, and it is 3. So we have defined this as well, and then now we have to do a1 into a2 into a3, and the result of the calculation needs to be in the date and time format, so we have to change this, and it will be order validity time. So here we, okay, that has been created. Long type is long. Okay, so now we have done these calculations for defining of many of the important points, which will then help us in the execution. Now we have to bring in more historical candles of 1 minute, and right now you won't really be able to make sense why 1 minute candles, but this is simply for defining the endpoint precisely. We will want to make sure that buy trade happens when the price starts to tick above the last hour candle close, provided the rest of the conditions are in place. And for the sell trade, we want the sell trade to happen as and when the price starts to tick below the last hour's candle close. And for that purpose only, we are going to need the historical 1 minute candles. So here we take those. Now we have to change the candle period to 1 minute, and this is also going to be changed to 1 minute, and shift is going to be 1. So here this has been changed, and this will become 2, and then we get the output values, candle 31 and the candle 32. So as you can see, we have got these conditions defined, and we are almost ready to start building on the buy side, but we will not do that in today's session. Instead, we will start afresh tomorrow, as most of the basic calculations and the foundation has been laid by bringing in these essential indicator blocks, which are now going to play a major role while helping us define and determine the entry point, the stop loss, the target for both the trade sides, the buy and the sell side trades. So with this, we finish off today's session. We will save this file, and then we will say it's time to say goodbye with the message of seeing you tomorrow again. Have a fabulous day ahead. Goodbye.